Thank you very much for watching this presentation. This paper, Machine Learning, the Skill of Mutual Fund Managers, is joint work with my PhD student Zihan Lin and Ron Caniel from Rochester University and Stein van Nieuwburg from Columbia University. So, the mutual fund industry is crucial, and over 100 million Americans invest in such funds. Mutual fund managers are actively investing in assets in order to outperform a benchmark. Now, the key question is, do mutual fund managers actually have skill and do outperform their benchmarks? And if yes, can we predict which fund managers and when do they actually have the skill? This is a challenging problem for a number of reasons. First, we have a lot of information available for funds, so we have a large number of variables that we can use to explain the skill of fund managers. Second, the skill of fund managers can depend in a complex way on all these variables. So we have a non-parametric problem. Third, the skill of fund managers can depend on time-varying economic conditions. Now, can machine learning help here? So when I talk about machine learning, I mean methods that on the one hand are very flexible because they're non-parametric, and methods that can deal with a large number of variables because they have some form of regularization. The answer is yes, we can use machine learning, but it has to be done in the right way. So in this paper, we're going to predict risk-adjusted fund performance using a very flexible and powerful machine learning tool, namely neural networks. We are going to use a large set of fund and holding-based stock characteristics combined with macroeconomic information to predict these risk-adjusted fund performance. So our main finding is that we can strongly predict out of sample the skill of fund managers. So we will measure the skill of fund managers as the abnormal returns relative to a benchmark factor model. So we show that we can consistently differentiate high from low performing mutual funds. The cumulative risk-adjusted return of the best 10% of funds are plus 72%. The worst 10% of funds have minus 110% cumulative risk-adjusted returns. These results are robust to longer holding periods and hold net of fees and are robust to the time sampling. We can also identify what are the key predictors for abnormal returns. So we show that fund momentum and fund flow are among the most important predictors for their relative performance. Importantly, fund flow will have a positive effect. We need sentiment if we want to predict the level of the performance. The characteristics of the stocks that fund holds are not predictive for abnormal returns. We also clarify that abnormal return prediction is different from just predicting returns. So as I explained before, we measure skill as a residual relative to a locally estimated factor model. Stock characteristics based on holdings will predict returns because they predict this time-varying factor exposure to our benchmark factor model. However, the residuals, which are our abnormal returns, cannot be predicted by stock characteristics. Only fund-specific characteristic can predict these abnormal returns. Last but not least, we identify important nonlinear interaction effects. So fund flow and fund momentum are more predictive and have a higher effect during times of high sentiment. And our flexible neural network estimator allows us to identify these nonlinear interaction effects with sentiment. Real economic activity, as measured by CF&I, does not have these interaction effects. Our paper also makes a number of methodological contributions. So first, we show the importance of a relative performance prediction. So abnormal returns are a relative target because they remove the very hard to predict level. And we show that the relative target leads to improved prediction. Second, we suggest to use prediction-weighted portfolios. So our prediction-weighted portfolios do not only use the relative ranking based on the prediction, but also the relative magnitude of the prediction signal. And as such, they will provide a better measure of the economic benefit of the prediction. Third, we show how to measure the dependency on macroeconomic states. We show that it's important that we have a cross-sampling that is such that it represents all economic conditions in all the samples that are used for estimation and evaluation. And that is crucial if we want to identify the dependencies on macroeconomic states. Fourth, we show how to measure interaction effects. So we propose a new measure for a global interaction effect. What is very nice is that we have a formal statistical significant test based on functional central limit theorems of neural networks. This allows us to have a very interpretable measure for interactions and also have a formal statistical foundation for this measure. Last but not least, we contribute towards a protocol of how to use machine learning in finance. So in most empirical machine learning papers, you will find a horse race of different prediction algorithms. We do it differently. We are going to vary the information set that we give to the same optimal and flexible machine learning algorithm. And that allows us to quantify what is the economic benefit of different information sets. So there's obviously a large literature that we build on. There are many papers that have studied fund return predictability and the performance of mutual funds. So different from that literature, we will use this flexible machine learning toolbox that allows us to use many variables and identify what matters actually. So these machine learning methods have already successfully been used to predict returns. In the case of mutual funds, there are two independent papers. They are methodologically different from ours. And from an economic perspective, one could say that at least partially, those two other papers are a subset of our more comprehensive analysis. So the paper by Lee and Rossi is predicting returns with machine learning methods using only stock characteristics, but no macroeconomic information. Now, the prediction of returns is essentially an orthogonal objective of what we are doing. We show that stock characteristics are irrelevant for predicting abnormal returns. So stock characteristics can predict returns because they predict the systematic factor component. But what we care about is this orthogonal component, namely the residual relative to local factor model. Now, De Miguel, they also use some abnormal returns as a target, but they only use fund-specific characteristics and no macroeconomic information. Now, our object of interest are abnormal returns. These are the residuals relative to a benchmark factor model. Now, what is important is that we estimate this factor model locally using the prior 36 months. That gives us time-varying betas. So this is essentially a conditional factor model. We're going to use a Farmer-French-Carhart 4-factor model. That means a market size value momentum factor, because this factor model is widely traded by funds and widely used in the fund literature. We show that our main results are robust to adding further factors. So we actually have an 8-factor model, and all the qualitative results are the same. Now, our data set consists of over 3,000 funds for over 40 years. We have monthly observations. For these funds, we have holding-based stock characteristics. These are based on the 46 most relevant stock characteristics, based on past returns, investment profitability, value, etc. I will refer to those as stock characteristics. Then we have fund-specific information. This is fund momentum, fund reversal based on the abnormal returns. These are fund characteristics like the age, total net assets flow, expense ratio, turnover ratios, and the corresponding family information. And we also include two macroeconomic state variables, namely investor sentiment, as in Baker and Wurgler, and real economic activity as measured by CFNI. Before I start with the main analysis, I want to give some motivation here. In finance, if we would want to understand what is the effect of some conditioning variable, we can create univariate sorts. So that's what I'm going to do here. I create decile sorts and look at a long-short portfolio, top decile minus bottom decile, for all of my 59 characteristic variables. The main takeaway is that the highest Sharpe ratio and the highest mean returns are for fund-specific characteristics. If we evaluate these long-short portfolios in low, medium, or high sentiment states, we observe that most of the profitability comes from high sentiment states. Now, this kind of univariate analysis is, of course, not sufficient because, number one, we study each characteristic individually. So we completely ignore that there's redundancy, how the different characteristics interact with each other, if there are any kind of if certain characteristics are not necessary, etc. We ignore interaction effects with macroeconomic variables. it's in sample, and there's a multiple testing problem, of course. Now, this brings us to our main model. So what we want to estimate are the conditional abnormal returns. That means what we want to do is we want to predict these abnormal returns using past characteristics and macroeconomic information. We are going to do this with a neural network. Neural network is a very flexible non-parametric estimator that can capture reliably complex functional relationships. Now, any type of machine learning estimation essentially uses one part of the data to estimate the model, that's called training, then another part of the data to choose tuning parameters, that's called validation, and then we have out-of-sample evaluation, the test data. Now, here I'm showing you the sentiment time series. The issue is if I use the data, let's say up to 2005 to estimate my model, and I evaluate it only after 2005, there will not be any high sentiment realization on this last part of the data. So mechanically, I will not be able to detect any interaction effects with high sentiment. So what is the solution? So what we propose is a cross out-of-sample evaluation scheme. So we will take our data set and we will create 3 folds. So we will randomly sample all the data points into these 3 folds. One fold will be the red data points, a second fold will be the green data points, and the third fold will be the blue data points. So note that all sentiment states, that means low and high sentiment states, are represented in all 3 folds. Now we are going to use 2 of these 3 folds that we use for estimating our model. It means it's our training and validation data. And then we will evaluate out of sample our model on the third fold. Now we're going to repeat this, where we use the different combination of the folds for estimation and evaluation. That means each time point will be used exactly once for out of sample evaluation. This is important for 2 reasons. So first of all, we can ensure that low and high sentiment states are represented in all training and evaluation samples. And number 2, our evaluation is not just based on a very small set of the data, but we will consider all time periods for out-of-sample evaluation. Now, it makes sense to do this because our economic object of interest is a conditional abnormal return that is essentially based on a cross-sectional regression of time t abnormal returns regressed on time t minus 1 characteristics. Now, you might say we cannot use future information for an investment strategy, but that is not the point here, right? Because what we want is to estimate the economic object of a conditional abnormal return. And of course, we also consider a chronological split of the data, where we have 3 folds based on the first third, the second third, and the last third. We repeat the same exercise, and all our predictability results continue to hold in terms with the chronological sampling. However, mechanically, we will not be able to identify certain interaction effects with macroeconomic states. That is why it's important to think very carefully how we sample data if we want to identify these interaction effects. Now, in order to understand what is the value of our prediction, we will form prediction portfolios. Now, most papers that form prediction portfolios do this with equal weights. For example, we form decile portfolios based on the prediction. So the prediction serves as a classification. And then we look at the performance of these different decile portfolios. We propose to use prediction-weighted portfolios that take into account not only the relative ranking, but also the relative magnitude of the prediction. So here on the left, I show you how the weights look for the top and bottom decile look like for prediction weights. On the right, here you see the weight for equally weighting. Now we come to the empirical results. So this is the main result. Please pay attention. Here, I'm showing you the cumulative abnormal returns for prediction-weighted deciles. All of these results are out of sample. So the black line is the top decile, the purple line is the bottom decile. So the first observation is that we can perfectly predict the relative ranking of the abnormal returns, right? So in particular, the bottom and the top decile seem to capture a lot of the predictability. The 10% best funds have a cumulative abnormal return of 72%. The 10% of worst funds, that's the purple line, have a cumulative abnormal return of minus 119%. That suggests that avoiding the worst mutual funds is even more valuable than investing to the best. All of these results hold net of fees. In fact, we also get a cumulative abnormal return for the top 10% of funds of 37%, even when we include fees. Now, when I look at equally weighted decile portfolios, the results are qualitatively similar, but they're of course weaker because we do not take into account all information. So the next question is now, what information matters? So what I'm going to do next is I do exactly the same time of prediction, but I use only a subset of the information. Here's what we get if we use only stock-specific holding information. What we can see is that stock characteristics do not help to predict abnormal return. Just keep in mind, the Lee and Rossi paper is only using stock-specific characteristics. Now, if I use only fund-specific characteristics, I can predict abnormal returns. So this is showing that what matters for predicting this residual component are the fund-specific information. Now, we have seen that most of the predictability is in the top and bottom decile portfolios. So in order to have a measure of the spread in skill, we create a long-short prediction portfolio. That's the top minus the bottom decile portfolio. That's a valid measure for the valid economic measure for skill, but it's not necessarily a tradable strategy because we're aware that you cannot short sell funds. Now here, I look at the cumulative returns of this long-short portfolio for different information sets. So the red and the green lines use only stock information, either with or without sentiment, and we see that stock-specific information are not predictive. The blue lines, so light and dark blue, they use fund-specific information, either with or without sentiment, and we see fund-specific information are needed to predict abnormal returns. Now I'm going to refine the analysis. I'm looking again at this long-short prediction portfolio, and I report the mean, the t-statistic, and the Sharpe ratio. And I do this for different information sets. In addition, I will also report a prediction R-squared. This measures how well we can predict the realized long-short portfolio return with our model. Now, what we can see here is if we only use stock characteristics, they are not predictive, right? This long-short portfolio has no predictability. In contrast, if we use fund-specific information, we get the predictability. It means a high mean, significant t-statistic, and high Sharpe ratio. If we add sentiment, the predictability only increases marginally. That means the relative prediction doesn't improve much if we include sentiment. However, the prediction R-square jumps up. And the reason is sentiment is needed to predict the level, but not the relative ranking. Now, we will identify the fund momentum characteristics and flow together with sentiment as the most important predictors. If I only use those the price trend-based characteristics based on abnormal returns, flow, and sentiment, we see that we get most of the relative predictability in terms of mean, t-statistics, and Sharpe ratios. Now, just to be clear, predicting returns is different from predicting abnormal returns. Here, I repeat exactly the same exercise as before, but the prediction target are returns. On the left, I use fund-specific characteristics and sentiment as my information set. On the right, I use stock-specific characteristics and sentiment. Now, we see that returns are predictable by stock characteristics. That's exactly the finding that Lee and Rossi has in their paper. And the reason why we can predict returns with stock characteristics is because stock characteristics predict the factor component. They predict these time-varying betas relative to the Farmer-French-Carhart model. However, once we look at the residuals to this model, then stock-specific characteristics are not informative. Now, these abnormal returns turn out to be a better prediction object because they're a relative object. So if we look at the Sharpe ratios and the R-squares that we get from either predicting returns or predicting abnormal returns, we see that we get higher Sharpe ratios and higher prediction R-squared. The reason is the following. If you have tried to predict returns, you have seen that we're relatively good in getting a relative ranking of stocks, but we are very bad at predicting the level of returns. When we look at abnormal returns, we take out this very hard to predict level, and that will help us to estimate a better model. Now we show that our predictability lasts over longer time horizons. So what I'm showing here is the abnormal return of my long-short portfolio from 1 month up to 36 months, based on my 1 month prediction target. The black line is based on fund and sentiment information, and we see that even after 1 year, we have a high predictability. This predictability even lasts for up to 3 years. And the reason why we have this long-term predictability is because many fund characteristics are relatively persistent. Now, we will get even better results for longer horizons if we use these long horizons as a prediction target. Now, which variables are important? Now, if we have a linear regression, we can measure importance by looking at the slope coefficients. Now, the generalization of this is to look at the partial gradient. So more specifically, our importance measure is the square root of the squared partial derivative. We see that the most important information is sentiment, the momentum of abnormal returns, turnover, the reversal of abnormal returns, and flow. Now, importantly, we also provide a formal statistically significant test for neural networks based on functional central limit theorems for neural networks. And we show that all the variables that are important here are also highly statistically significant. Next, we are going to evaluate our model in different sentiment terciles, either low, medium, or high sentiment tercile periods. So I'm here looking either at my long-short portfolio or at the bottom and top decile. And what we can see is that the conditional mean is the highest in high sentiment periods. Also, the predictability, that means this prediction R-squared, is the highest in high sentiment periods. This also suggests a market timing strategy. If we buy a long-only portfolio, buying the best predicted funds in high sentiment periods, that means in periods where we have high predictability, we can earn an average monthly abnormal return of 27 basis points. So why do we observe this effect with predictability based on sentiment terciles? The reason is we have nonlinear interaction effects. Here, I'm showing you the conditional abnormal return as a function of fund momentum and sentiment. Now, a conditional abnormal return is a function of many variables. Now, here I'm only looking at 2 variables, and I set all the other variables to their cross-sectional mean, which is 0. Now, what we observe here is that in high sentiment periods, that is by the purple, indicated by the purple line, the effect of fund momentum is much more pronounced than in periods of low sentiment. Now, this is a nonlinear interaction effect that can be captured by our flexible neural network. Now, in order to quantify this interaction effect, we will measure the slope of this line in high sentiment periods and compare it to the slope in low sentiment periods. That is exactly the definition of our interaction measure. So the different fund-specific characteristics have a high interaction effect with sentiment, in particular for fund momentum, fund reversal, fund flow, and fund turnover. Now, we also provide a formal statistical significance test, and those bars that are large and high here, they're highly statistically significant. We show that CFNI does not have these interaction effects, and all these small little black bars, they are not statistically significant. So we also suggest an explanation for our findings. So we have identified flow and fund momentum as some of the most important predictors. And flow can predict fund performance because investors detect skill and reallocate investment. Fund momentum can predict performance because its reallocation is slower than in a frictionless model like in Berg and Green, and therefore skill leaves trails through gradual flows. We observe interaction with sentiment because funds attract flows through marketing. This creates buying pressure for the stocks funds hold, and that will create a downward sloping, in a world with a downward sloping demand curve, will raise prices and lift fund returns. And that will create more inflows in the next period and will be stronger in times of high sentiment. Now we have tons of robustness results. Many of these robustness results are in our revised version of the paper. So we show that our results are robust to using a chronological sampling scheme. I mean, obviously, as I explained before, some interaction effects with sentiment will mechanically not be observable, but the relative prediction results, they are very robust of how we sample the data. We show that our results are robust to including fees, so the whole net of fees. We also decompose abnormal returns into a between disclosure component and a within disclosure component. And we show that 50% comes from active trading within the quarter, and 50% comes from keeping holding weights fixed at the quarterly reported holding positions. We also show that our outperformance is not compensation for standard risk factors. Now, what is important, if we run a time series regression ex post on some prediction portfolios using constant betas, that is completely different from using a local regression to get our residuals, abnormal returns, and then trying to predict those. These are two completely different things. We also show that our results are robust to the fund size. So we get similar results after excluding small funds or using value weighting. And importantly, our results are extremely robust to tuning parameters in the network structure. So what matters is not the number of layers of our neural network. What matters is how we set up our problem. So let me wrap up here. So we show there is strong predictability in abnormal returns. This predictability holds out of sample, is long-lived and economically meaningful. We identify fund flow and fund momentum as key predictors. Both of them have a positive effect. Stock characteristics based on holdings are not predictive. We show their important interaction effects. So fund flow and fund momentum matter more and have a larger positive effect during times of high sentiment. There are no such interaction effects with CF&I. And methodologically, we contribute to prediction methods. We show that abnormal returns are a better statistical object because they're a relative prediction object. And we also suggest to use prediction weights to better reflect the economic benefit. We contribute towards model evaluation by introducing a novel measure for interaction effects with a statistical inferential theory. And we suggest an out-of-sample evaluation that ensures that all the relevant macroeconomic states are represented in training and evaluation periods. And last but not least, we contribute towards the protocol of using machine learning in finance and suggest to vary information sets to compare the economic benefits of different information sets. Thank you very much for your attention.